stock market was returning massive amounts, right? But now we are starting to see that rip higher. So let's take a look at the gold chart here and see what we have. So the first thing to keep in mind is that the signals on the chart were absolutely there. And what do I mean by that? Well, we had the 2020 high here. And if we draw a trend line across, look at how it...
In today's movie, Soloway talks in great depth about what is making the gold and Bitcoin markets go up. Before we go any further, let's watch the video. GTH talked about what he thinks will happen with Bitcoin in 200 and 2024, as well as the future of inflation in the US dollar.
Kept on hammering on that resistance line. And ultimately, that becomes like a doorway, right? You keep on pounding the door until it finally breaks through. And then you get this explosive move to the upside. And that's what we've gotten here. Now, having said that, do I think gold eventually goes higher? Yes, I think 2,500 this year is a lock. I even think 3,000 over the next 12 to 18 months is definitely a possibility. But I do want to just mention here, and I'm a shorter term investor and trader, so I do want to just mention that I do anticipate a pullback before it goes higher now. And I want to show you guys where I get that from. So what I'm going to do is I'm going to flip over to the monthly chart. And I use technical trend lines. It's kind of my go-to move. So if we take the high of 1980 right here, which was an explosive high during a high inflation period, and we take that and connect it to our high from 2011, it takes us exactly to the current highs on gold. All right. So again, while I still think gold has more upside, you have to respect a trend line that goes back 40 plus years that we probably are due for some sort of pullback. I even think we could get a pullback to about 2075, which was that breakout level. But basically, I'm just in the position, Charlotte, where pullbacks are buying opportunities. I don't see a way that the Fed can get out of lowering rates when the economy gets messy, where they're not going to print money, where the government, I mean, how does the government pay down a debt when the interest alone is north of $1 trillion? That's just the interest, right? So all of these signals point to a Fed that is going to have to push interest rates down at some point, and it likely means that gold does go a lot higher. And this is such a great thing because there's so much kind of questioning about when we will get that kind of big first cut. Is it going to be in June? I mean, I still remember at this time last year, people were already anticipating 3 rate cuts last year. And then before you know, it was no rate cuts, but 6 this year. Now it's down to 3 and it's almost down to 2 at this point. So it's really been a change. And that's all because, in my opinion, the labor market has remained strong, but also we've seen inflation beginning to uptick again. In fact, really some incredible charts here. I want to just show you guys some various charts that we have on some of these commodities. So let me show my screen again and we can delve into this. So we looked at gold, and gold's had a huge move, but we know that silver's also had a major breakout, and silver is partially an industrial metal. So we know that that's also very telling about kind of the prices that are going to be passed to investors down the line. We look at copper, right? Copper's had a major move as well, where you've now surged to the upside, and we're trading at levels we have not seen since 2023. And we're actually at a pivotal point here where if we break this on copper, we could be headed back to $5 on copper, which would be remarkable. And then, of course, how could we not mention chocolate, right? The chocolate chart, explosive move to the upside here, just since the beginning of the year, up over 100%. And one of the favorites for most people is coffee. Look at coffee's recent move here to the upside. So to be honest, we look at these signals, and if commodities are going up, it's eventually going to get passed to the consumer. And it's hard for me to imagine how we are going to get inflation back to the supposed Federal Reserve goal of 2%, right? And again, I think they're going to move the goalpost. They're going to say, oh, well, 3% during a bad recession is okay. And they'll start cutting and printing at that point, which ultimately we just are going to have to pay for later on with higher amounts of debt in the system and higher inflation. It's unfortunately, to summarize, it's kind of like a snowball rolling down the hill where it just gets bigger and bigger and bigger. And there's no end until that snowball smashes into a brick wall, if you will, and just collapses. So it does seem more and more like it's going to be kind of when the stock market finally has a big flush, when the jobs market it doesn't seem as much that people are saying, oh, the jobs market is just going to slowly weaken. It's more that you're thinking at this point that it's going to hit a wall, and then you're going to see unemployment start to spike dramatically, and the non-farm payrolls number is going to go dramatically to the downside. So I think that's kind of the vibe most people are getting, and I actually think that that's fairly true. I think the signals for slowdowns are there in the charts. In fact, I want to show you a couple key articles that I've written recently that really speak to the trouble in the system that a lot of the mainstream media is not pointing out. So this was an article I wrote just earlier today, and the headline speaks for itself. But basically, credit card delinquencies are surging, and we're at 10%. And to put that in perspective, you haven't seen 10% since really going back to the COVID pandemic major catastrophe, right? When everyone was panicking. And then before that, you have to go all the way back to 2008, 2009. So what this tells me is the consumer is feeling stretched. If they're delinquent on their credit cards, they're unable to pay their credit cards. They've kind of run out of room here. A couple other articles that I think are worth taking note of here. Let me just scroll down, and I apologize for this, but another headline that I came across, commercial bankruptcies have jumped 43% just in the last year. That's massive. That's telling you that businesses are not doing as well by far. And then just one more here, insider selling spikes to the highest level since 2021. And again, we know 2021, that was when we saw the stock market peak last time. And insiders, again, were dumping like crazy, and they are dumping like crazy here. In fact, there's a great chart here on this I want to show you. Look at all that red, and look at how tiny the little bits of green are. Those are insider buys, the green, and obviously the reds are sells. So again, for me, I look at this and I say, the mainstream media is pointing out how great things are and how strong the economy is being maintained. And then I look at things and I say, wait a minute, that might not be the case, right? Maybe we're actually seeing some other factors here that are actually struggling, or we're seeing struggling within the economy. So I would just, caution people to be aware of this. Just a couple, and bear with me because I think this is so important for investors to see. But if we go down to some of these charts here, number one, the Federal Reserve, or I should say the government, is one of the key hirers. So last Friday, we saw the jobs report talking about 300,000 jobs were created, right? Well, look at the amount of hiring that the government's doing. Basically, the government is hiring a majority of these people. And then also other scary tactic signals are that the full-time work has actually been declining the last 3 to 4 months, while part-time is making up the difference. So people are having trouble finding full.
We'll have the usual mix of macroeconomic numbers and commentary from top Federal this week. This isn't rare for Federal Reserve officials like Chair Jerome Powell to do this, but events in the Middle East could make risk assets even more sensitive to rising political tensions. In a few hours, we'll see how the market responds to these events. Here's a buying guide for the weekend. The code letter had a weekly schedule entry for X, which was the start of trade in Asia on Wall Street. On April 18, jobless claims will be released, which is the most important data for the week. Powell will speak on April 16. Traders have priced in many times that interest rate cuts will happen this year, but inflation is still a big deal for them. The CME Group's Fed Watch tools show that there is a 43% chance of a 25 basis point rate cut at the July meeting and a 45% chance of one in September. This is since rates are very important to the market right now. The market went through wild swings over the weekend because of new data that changed the outlook for rates. As a result, almost all of Bitcoin's original block subsidy housing that was built at the last minute was lost. Traders are still focused on price rather than the big network event that has been building up for months. Miners are at the front of the changes because their income streams are changing right away as the number of new Bitcoins per M block drops by 50% to 3.125 BTC. However, new data from on-chain analytics firm Glassnode shows that the amount of Bitcoin held in known miner wallets has stayed mostly flat since the end of the event.